The economy has a very big problem on its hands, and I'm going to explain why today. You came here for the truth, so let me unveil that for you. What we are looking at here is a dire scenario. I'm just going to break it down for you. I don't want to be the bearer of bad news, but here it is. When we look at the trajectory of the United States, let's be honest, other countries are in the same scenario. It's really bad, okay? I don't know how else to say it, but I'm gonna actually show you mathematically why it's impossible to get out of this circumstance. It's so bad right now that we have never seen a time like this before, okay? Because the bubble has grown so big that at the same time, when they're saying this is, we have the global systemically important banks, we are too big to fail, all of that, it's too big to bail, not too big to fail. I'm going to explain why here today, starting with this. I've shown this before, and I want to make it clear. He's going to start this video off with this. U.S. interest payment scenarios. So it's over $1 trillion. And by the end of the year, depending on the scenario, we could be seeing potentially $1.6 trillion in interest payments. Interest payments. And what's interesting about interest is that it gets paid regardless. It gets paid regardless of whether you can afford it or not. Janet Yellen, my favorite, she's going to make sure that the interest payments get paid before your roads, before your bridges, before your social security or whatever social assistance programs you need, your community needs money. No. The debt is number one. That fictional debt that should never even exist. There's no reason for it to exist. But the way that the money system is created, you have this being a burden on you more than anything. And of course, they cannot pay off the debt. It's not possible. That it is literally impossible. It is mathematically impossible. And we are going into, look at that. It's going from bad to worse. Do you see? It's just going straight up. It's a hockey stick. It's going straight up in here. And that, of course, you think the situation is bad today. You think so, but you got to look further out. I showed you the report, if you watched that video, of the RCMP. Think of that like the FBI of Canada, okay? Think of it like that. They produced a report that was secret, that was only meant for internal use, but through the equivalent of a Freedom of Information Act request, they got that. The vast majority of it is redacted. The information that was in there said 5 years, we're going to see turmoil and civil unrest. People, because everything's too expensive. That's exactly what I've been saying for years. That's still in my head every day, thinking about that. And I wonder what was under all of those redactions. I have a feeling it's based on the response, the RCMP's response to people being pissed off about what's going on. Gross issuance of US Treasuries. Do you see what's going on here? Okay, other than obviously 2020 crazy time, but the trend is very clear that the government is going into more debt. And as they do that, you got to pay that off. If you want to spend money, let's put it this way. If the government wants to spend money, it has to basically spin up this, U.S. debt, put a little bow on it, put a little into a package, put a little bow on it, and sell it off to an investor. And that's okay. Like, they can just continuously and perpetually do this. That's why the U.S. dollar is what it is. Everyone loves U.S. dollars. There's just one problem, though. There is a ceiling on that. So if they wanted to tomorrow to issue, 100 quadrillion, well, there wouldn't be enough of a market to absorb it. Who's going to do that? Long term, the Federal Reserve has to. And so they will monetize the debt. And we've seen this happen before. It won't be the first time that has happened. But as soon as you do that, it's like a snake eating its own tail. And you will be in an environment where, imagine like the walls are closing in on you. That's what it will be like. It will be as if you're getting crushed by a massive, like a garbage compactor, and you're just getting crushed in there. That's what this is. Higher yields rapidly increasing US's interest expense. No doubt about it. So you've got the dollar value there where it is today. But if they're going to leave interest rates higher, oh my goodness. If they're going to leave them at these levels, it is going to punish everybody holding on to debt. Okay, it's not just the government itself, but that obviously is a problem. This is just showing us money market funds. Suddenly, there's this rush for the exit. Money market funds, the worst we've seen since the Lehman catastrophe in 2008. And so we're going to see where this brings us. I'm not so sure. But it's interesting. I'm putting a question mark on this one, but we'll see over time, maybe in the next week, if any big changes where that flood of money has gone. The EPFR brings us, some information on that, and hopefully I can bring that to you. Finance Friday. But so by the time this video is public, I've already covered this with the Finance Friday crew. So I'm excited to get into this for over 2 hours. We'll be talking about all of this. Total Fed reserves continue to fall. Looking at this domestic, you're looking at the RRP, which is basically reverse repos. And then we can also look at the reserves. When you combine those together, it's declining down. And, what they're saying anyway, $3 trillion is that sort of tipping point where they can't get below. And there's an issue there because at the same time, they've been pulling liquidity. You got to have this liquidity. It's got to come from somewhere. Reverse repos, okay? They're trying what they're trying there. This is nonsense anyway. The repos and the reverse repos, you use that with a broken system. And the reserves, okay? So this is basically commercial banks keeping their excess reserves at the Federal Reserve. That's what that is, okay? Commercial banks keep excess reserves at the Fed. They park it there, earn a little bit on that. And reserves happen to be very correlated, highly correlated with the stock market. If those do decline, well then, stock market can go down as well. And I'll show you that in just a second. I have that chart prepared. You're looking at the total assets of the Fed continuing to decline as well. And so you got to realize what's happening here. They're pulling liquidity from the system. And of course, that's going to be an issue for the stock market, yes, but the broader economy as well. Reserves still higher than when QT began. Think about that. So the reserves are higher. They're trying to drain liquidity from the system, but the reserves, they're being parked. They're, basically the banks, instead of loaning that out to people, instead of investing it or doing whatever, they're just parking it at the Fed. All right. So their idea of trying to, tighten financial conditions has not worked. The Federal Reserve's idea there hasn't worked, if we believe what they say. All right. And then we have this, important. This is showing us the reserves and the stock market. And when they get out of line, they usually find themselves coming back together. And we did see that in late 2023, where, by the way, you might not see it necessarily touching the line. Doesn't work like that exactly. But it, you can sort of shift this based on how long you pull it out for and everything else. But the point is, when there's too much of a divergence, it usually will converge. And it won't happen like you're not going to see it coming. It just happens. And I believe that it's usually when people think that it will never happen, that it does happen. So you can see that, okay? The green line just being the stock market, obviously, and the red is as it says here, U.S. reserve balances with Federal Reserve banks. So that's an issue. Just looking at this overall, when we see what's happening with the financial system, liquidity, they're trying to drain it. It's not working. People are pouring more and more and more money in. It's basically a powder keg. And that doesn't end well. It really doesn't end well. We also have the factor that there is an election. Yes, that's important. But at this time, we have an issue with inflation. And so inflation is sticky around this range. They want that to come down. They need to leave interest rates at these levels. Some have talked about increasing. I'm not so sure about that. But it wasn't coming down to the level that they were so confident about. And now they're saying, well, we just need more confidence in the data. And so they're going to wait. And that puts more pressure on the national debt. You got to understand that as that increases, your services will be cut. They will take from you to pay that debt. Do you understand what I'm saying here? Like people are thinking, well, whatever, it's good, it's good. No, they're going to take from you. The higher these interest rates go, the more interest they have to pay, the less for you. I don't agree with the system. This is a criminal system. The way that it's designed is to rob from you. And we keep saying, you know what we should do? We should tax the rich more. That doesn't have any impact at all. The system is purely designed as a fraud. The money, the value is born out of debt, out of nothing. You can't fix this with taxes. That doesn't do anything. It means that you're going to pay more, you're going to get less. You have to get wise to the situation. I hope that you'll see my playlists on YouTube. I've got all kinds, how-to and solutions. I've got the e-courses in there, all kinds of stuff. Okay, just to try and enlighten people as best I can within this frame. If you want much more detail, well, then you got to get on my live sessions. The link is at the top of the description. Before you go, did you hit the thumbs up button yet? Wait, I can't hear you. I can't. For some reason, I can't hear you. Okay, anyway, if you can, no, I didn't get that. Okay, just hit that thumbs up button. I'll see you tomorrow. Take care.